Welcome, everyone. Thanks for coming. Forecast 2013. We're going to go over what some of the pundits said last year that might happen last year, and how some of the investments went, and some of the world of popular finance, how they called it, and if they were accurate or not. We're also going to talk about some of the things we are looking at for the remainder of this year, for this whole year, 2013. All right. So we like to warm up. Did anyone recognize this word? No one recognized this word? Well, this is everywhere now. So what do you think it means? Could it mean this? No? Yeah. Simple enough. We've completely manufactured a bunch of terms this year, so this is some of them. New revenue, what does this mean? Whose revenue, right? Taxes are going to go up. So we're going to talk a little bit more in depth about this, and I'm sure that I'm in Berkeley, so it makes sense that some folks here are going to say, yes, more taxes are great, and some folks are going to say taxes are not good. And I sort of don't care. I just want them to fix it. I just want them to figure it out, whether it's cuts or taxes. All right. Anyone know what this is? Yeah. That's a name. Yeah. You only live once. Don't even need the questions. Look at that. So you only live once. All right. So how many of you have been to one of these before? Okay, most folks. So we tell the story about 7 years ago, not 7 years ago, wow, 12 years ago now, I started the conversation with my clients then when I was at a Wall Street firm. And I asked them, if I was to go independent, which you're not supposed to have that conversation with clients when you're at a Wall Street firm, but I had the conversation, I asked the question, if I was to go independent, what would you like to see in an independent firm? And everyone there said, we'd like to see more education, greater communication, and they also said planning. So this isn't about planning, but we've made the commitment to each of you in the room for whom we manage money to have this conversation on a regular basis, to be very open and be transparent with some of the things, as transparent as we can be. Right? You're going to ask questions, and I'm going to answer them. Sometimes I'm going to use words and things, and I after we get the, Jonathan, that was really too complex, or I get a lot of these kind of conversations after the fact. So keep asking questions until you understand. If you want to know something and go into depth, I'm happy to do it up here. I'm happy to do it offline as well, okay? So we do this out of a commitment, and the reason that commitment exists is because we don't believe, and this is really critical, we don't believe any advisor can predict or control what markets do. Does that seem reasonable? No one can predict or control. So what we're left with is we're left with behavior. We're left with doing the right thing, which means staying educated, understanding the trade-offs we're making, which means we have to communicate a lot, because this is behavior management, right? This is us trying to say, this is what we're thinking, this is what we're seeing, this is what you can expect from us going forward. Does that seem fair? Okay. So who here thought that the S&P was up 16% last year? Two people. From January 1 to December 31st. It's 13 point some percent in performance, a couple percent in dividends.
But the question is why? I mean, that's what I don't understand.
That's what we're going to talk about. That's a lot of what we're going to talk about. So we always want to talk about our performance, but right now we're going to talk about some indices. So what was the single best performing market last year? Just take wild guesses, because it will have to be a wild guess.
Banks.
Any ideas? We have banks. It's a great idea, by the way. As a sector, it was a great performing sector. Technology, good idea. It was Greece. Yeah, every head. Greece was the top performing market last year, January 1 to December 31st. In fact, if you bought Greek bonds January 1st and held on to them, you would have made an incredible sum last year. Why? Well, that's not. So the currency is the euro, so it's not necessarily currency related. It's pure fear related. Right? Remember, beginning of last year, what was going on? The conversation was Greece was going to leave the euro. Right? That was the conversation. So everyone fled the Greek market. Now, I'm not saying that was a great market. I'm saying it recovered. Doesn't mean it's a great investment now. It's just something to be aware of that, holy cow, that was the best market. But everything, I mean, most things did pretty well, right? And yet we feel so, it's such a tough year, so much volatility. So who thinks this is going to repeat next year? Yeah, no one. Maybe it will because of that. And we'll talk a little bit more. All right. So at the beginning of the year, this is what we heard, right? And so that's what the markets did. Here's what some of the geniuses said. So we see, everyone knows who Jim Cramer is? Pure entertainment. He is funny to watch, completely worthless as somebody to get information from. Right here, this is what he said. He said he warned investors to avoid bank stocks. The single best category investment in the U.S. was banks. I mean, even Apple underperformed banks. Okay? Why? Again, well, we'll talk about that. That's going to be, we're going to go a little bit more depth on that. He also said this, avoid houses, and yet, here we go, up 14%. So housing and banks were two of the strongest sectors. Jim Rogers, shorting the stocks. Remember, stocks are up 16. Now, this is all January 1st. He might have changed his mind, by February and been long stocks. But this is the stuff you hear. Now, this, I think, is really important to understand. Everyone know who Bill Gross is? No? Bill Gross he's a managing partner at PIMCO. PIMCO manages more bond money than anyone else on earth. For institutions, for individuals, you might have heard of the PIMCO Total Return Fund. It's in every one of your 401ks. It's in every 401k in the world. It is the most ubiquitously held fund out there, okay? Here's the interesting thing. So these are of 65 market gurus. The median accuracy is 47%. Bill Gross is 46. He's the largest bond manager. So accuracy, 46% of the time he's accurate. Grantham is probably the greatest macro trader out there. He looks at the big picture, decides whether he wants to be in, what capitalization he wants to be in, what type of security he wants to be in, what geography he wants to be in, and he'll trade all kinds of things versus each other. But they're two phenomenal managers. They're only right about half the time. Interesting, right? You don't have to be right all the time.
Is that enough to make money on?
PIMCO has done incredibly well. They've made a couple mistakes, everyone has, but they've done really well. Okay. So, 2012, word of the year. Does that make, right? Uncertainty. Recount what happened in 2012 really quick. What were some of the massive things that, say it again?
The real estate market collapsed.
In 2012?
Was it 2000 or was it 2000?
That was 2008. 2012, it actually started recovering. So at this event 1 year ago, we said probably in 2012 we'd see a bottom and a stabilization in real estate. And we've seen both a bottom and stabilization. Does it continue that way? We don't know. And we're going to look at a slide, look at housing in a second. But think about this for a second. If housing is bottomed, and if housing goes up from here, is that a positive or a negative for the economy? Even if it goes up slow and steady, it's a huge positive. Huge amount of jobs. That's where so much of the employment was lost, and if we have to build more, that's a huge positive for the economy. And that's one of the reasons we're seeing a lot of the positive data come out right now, is because housing is stable. All right. So I toyed with whether or not to put this particular photo in there. So the reason Europe turned around, the only reason is because confidence was reinitiated. And the way it was reinitiated was this. Quote, end quote, Mario Draghi comes to power and he says, we will do whatever is necessary to protect the euro. And he produced, and I don't remember the acronyms for them, but there's 2 different programs, and they said that we would purchase bonds, we would purchase euros. They haven't done either one of them. They have not employed either of the tools that he promised that could be employed. Because the minute, remember the slide last July that we talked about where the rates started ticking down for Portugal, for Ireland, for Greece, for Spain, and for Italy? The moment he said anything necessary, that moment marked the worst moment, and it just has gotten better since then. We took off one of these issues off the table.
Who was he?
Mario Draghi is the equivalent of Bernanke in Europe. For the European Union, for the EU. Okay? So he says, I can print money, right? And the ECB works with him on that. Okay? So why did we put Malcolm X up there? He said the same thing. Little different flavor of context, but he said the same thing. That's why he's there. And given Monday, we figured we'd throw it up there. Okay. And then after Mario Draghi said that, that was off the headlines. The next thing is presidential election. And then we fought through that battle, right? Oh my goodness, back and forth, who's right? We need lower taxes for everybody. We need lower taxes for people that make less money. We need to cut everything. And that was resolved. I'm not going to ask anyone's opinion about how they feel about it was resolved, but it was resolved. And markets have responded positively. And so if you ask the other side, they would say it would have been a negative response. Markets haven't been negative about this. And then that's off the table. We go to Fiscal Cliff, right? So it's serial issue after issue after issue. And that never goes away. We should always expect it to be serial issue after issue. Have you ever heard of the wall of worry? The wall of worry. Wall Street climbs, or the market climbs, a wall of worry. And the time we should be afraid is when Wall Street ceases to worry, when we don't have anything else to worry about. Why? Because the minute we don't have anything else to worry about, and this happened in the .com, it happened in real estate, it's every last penny that could have been worried is now in the market. No one else is left to invest to drive it up further. And that is when bubbles occur. So worry is actually a really good thing. And for there to be worry is positive. Okay, so which makes this January effect for me kind of scary, right? Because there's no worry right now. I mean, there's a lot of issues, but everyone's so excited about the market. And all the headlines are, everyone's returning to the market, all the market, right? So that we should be wary now. Now's when we start having lifeboat drills. Now's when we start talking about the downside. Okay. And here's how they resolved it. They resolved the fiscal cliff. First, did they resolve the fiscal cliff? No. Did they get remotely close to resolving the fiscal cliff? No. What did they do? They solved, $120 billion worth of a multi-trillion-dollar problem. So they raised taxes on people that make $400,000. And they made tax cuts, Bush tax cuts, followed by Obama tax cuts, permanent for everybody else. So is that enough?
Just a second. It doesn't look like it to us.
No, it's absolutely not enough. And so there's the problem. So we have seen, everyone here that has a paycheck still has already seen their paycheck go down about 2%. Okay, so that's going to affect, that's going to affect purchasing and consumer sentiment, and you've already started to see that in consumer sentiment numbers. We've got people coming to the office and, my check is $100 cheaper than, $100 less than it was because of that additional tax. Now, if you made $400,000 and your check is, $3,000 less for the year, I don't feel so bad for you. But someone that makes $20,000 and their check is $100 a month less, that's a big deal. Okay, so all the talk about, hey, we're going to make this better, it really went sideways for a lot of folks. Okay, it didn't really help, and we haven't resolved the problem yet. So Obama's going to press for more taxes, definitely, and Republicans are going to say yes if it's more taxes for everybody. So just keep that in mind. We're going to see that probably this year. The question is, the conversation seems to be about tax cuts tax increases and spending cuts. Right. And is there a way to inject into the conversation the need for growth? And I would also say there's another part of the conversation, and that's the inflation factor. Right? We will inflate our way out of the deficit by a large extent. Mm-hmm. And so I think all four of those things are on the table. And that's why you see the US going one direction, opposite direction that Europe is going. Right? So Europe is saying we're going to resolve this through austerity. And they don't really have a choice. So Greece is going to have to go through some very tough times. We don't have to do that. We can instead basically not borrow money, we can print money and we can spend in the economy to stimulate growth. That's the whole thing, is the stimulation of growth. The whole argument about do we increase taxes or do we print money? We just need to spend the money, right? The issue is, do we spend it? And we're going to print it to create growth. The issue is, there's a point when that bill comes due. And that is the question I go every day and talk to people and analysts, and nobody has any idea when the bill is due. So what do I mean by the bill being due? There's a point at which the bond market, those people who are buying those bonds, you know, we print money and people, or we print bonds and people give us money for those bonds, right? So then we have that cash that we can use. So there's a point where they're not willing to do that at 2%. Or actually, it's not 2% now, at 1.5%, which is what, you know, if you buy a 10-year treasury, you're going to receive 1.5% in interest, which is nothing and should scare you, and you shouldn't buy it. But to George's point, people buy it. Countries want to buy it, hedge funds want to buy it, people want to lever up and buy it. That's a bubble, right? So we just don't know when the end point is. And that's the fundamental question, is we just don't know when the end point is.